Hey all, welcome to ShareTreck. Today is Sunday and this is our Sunday edition, and I want to take this opportunity to reiterate how I think the market is going to behave, and I also want to present a few experts in the field and what they have to say about it and how it matches with my thinking. This is my way of just validating my own sanity, my own analysis. So please bear with me and let's get started. So let me start off by outlining my theory of what's going to happen to the market in the near future. So my vision is that because of the fact that the Fed has already raised interest rates, and also it's tightening by reducing the size of its balance sheet, so it's reducing the mortgage-backed securities renewals. It's also reducing bond purchases. So as a result of which money is being mopped out of the system. When money gets mopped out of the system, it becomes difficult for people to spend the money, and the money becomes much more valuable. And when money is much more valuable, it has a deflationary pressure on the prices. The prices tend to go down because for the same dollar now you can get more. So that's the effect that the Fed's current actions should already have. On top of that, we also have as we see every morning in our daily update, US dollar index is going up. That means the US dollar is becoming stronger and stronger against other countries. When that happens, US imports become much cheaper. When US imports become cheaper, then that feeds into deflationary pressure. So along with the Fed action, we also have the US Treasury, US dollar index showing us that there has been a lot of dampening of the inflation through imports. Now, on the other side, what's going to happen is that exports from US are going to become much more expensive, and as a result of which the margins of companies which depend on exports is going to be reduced, and therefore they may have poor outlook, and they may have less sales, and they may have less margins, and they will not do very well, and as a result they will let go of some employees. There will be some downsizing. So the tight labor conditions will become a little bit looser because now more people are available to work, and that's how things are going to happen. And because the Fed, instead of just raising the interest rates, is also doing the balance sheet tightening business, reducing its balance sheet size, it's a double whammy. Personally, I would have preferred that instead of raising the interest rates, if the Fed had gone about tightening the balance sheet first and then come into interest rate hikes afterwards, it would have been a better option, because we wouldn't see the kind of serious inflation that we are seeing right now. That is my personal opinion. But what do I know? There are much better experts out there in the Federal Reserve who have spent a lifetime learning these things. And in their own wisdom, they have decided to do balance sheet tightening as well as interest rate hikes simultaneously. One of the other problems we have now is the Russia-Ukraine war, which doesn't seem to be getting over, and the wheat shortage. So the wheat shortage and the oil is the main concern I have, which makes me fear of a stagflationary environment where prices remain elevated and unemployment remains high, and the economy doesn't make any progress. There is no growth in the GDP. That is the situation we were in when we did the oil embargo last. And right now, Europe is embarking into an oil embargo, which is going to click in the next 6 months on a phased manner. And when that happens, Russia is not going to get much money from its oil sales to Europe, and it has to find new partners. And the new partners are definitely going to ask for a discounted price because there is a sanction regime going on. So Russia is going to have that kind of a problem. Also, Russia happens to be a major producer of wheat along with Ukraine, and Ukraine's ports are all under attack. So it's difficult to send anything out of Ukrainian port or into Ukraine through the ports. So Ukraine has its own problems, and the wheat that used to come from Ukraine and used to go to Turkey is no longer going there. So Turkey itself is having a huge problem because of hyperinflation. The Turkish lira is very, very weak despite all the measures taken by the Turkish authorities. So you can imagine for them importing expensive oil and expensive wheat is going to be very difficult. So there's going to be a lot of trouble brewing in Turkey. But coming back closer home, high wheat prices mean that everything from pasta to bread to cookies to cakes, everything is going to become expensive. And now, if you look at this demand and supply theory, everything being constant, if demand increases, the price will go up. And when the price goes up, the demand for the item falls down. This is the general trend of demand and supply economics. There are some category of goods like luxury goods, for example, and essentials of life. They are highly inelastic in demand. What I mean by inelastic in demand is that regardless of the increase in price, you're still going to buy salt. And when it comes to luxury goods, it's more prestigious to buy very, very expensive things and show to other people that you can afford it. And that gives satisfaction for consumers of luxury goods. Therefore, luxury goods typically do not feel that much of a pain when there are difficult economic conditions, because people still want to show off their wealth. And the super wealthy definitely look at, for example, Bentleys and other things probably would not feel the kind of pain that a Toyota or something else would feel when the markets become tight. So that's what I mean by inelasticity of demand. Wheat is very elastic in its demand, but when it comes to a crunch, it becomes inelastic, because if the basic necessities are not being met, then people are going to be willing to pay any price possible to get wheat, because it's basic food. So when wheat is abundantly available, and if one shop has got a slightly higher price and another has slightly less, people don't think too much, just buying from whichever shop they can. But when it is known that the whole supply of wheat itself is short of demand, and then the prices are high, people are going to compete with each other to buy the wheat as soon as possible. There will be other middlemen who will try to buy and hoard these commodities and sell it at a premium. So all those shenanigans will happen, and they tend to push us towards stagflation. So we hope it doesn't happen in this case, but that's my overall blueprint. And I'm thinking that if the Fed sees the potential of a stagflation somewhere towards the end of this quarter, and also sees that the inflation has dropped, and that the productivity is reducing, and the people unemployment level is going up, the labor shortages become smoother, and there's abundance of stock of non-essentials which are being sold at discount, then probably the Fed would start slowing off somewhere around the third quarter of this year, and fourth quarter of this year should see us go back up again. This is the smooth landing version. If the smooth landing doesn't happen, and if the Fed do not put the brakes at the right time, then there's a good potential that we may get into stagflation. So that's my theory. Having said that, I want to show you a few clips, and I'll talk to you at the other side.
Well, hi, Cathie. Thank you very much for asking me to be on this discussion with you today. Really, really appreciate it. And there's certainly a lot of very, very interesting things going on, and some disturbing things, quite frankly, that are going on. And so there are many drivers of economic activity, but perhaps the two most important are both monetary and fiscal. Let's start out with the monetary side of the equation, which is page 2. And on the monetary side, the Federal Reserve is now raising interest rates. But actually, that's in a background of other central banks that have been raising rates already for over a year. We've counted over 180 central bank tightening moves. That is 180 interest rate increases over the past year. Not 180 central banks. There are many central banks that have actually raised rates several times, which is now what our Federal Reserve is just starting to do. But we are a global economy, and it is global rates that drive our economy. And it's not the level of rates. Here you see global short rates are still very, very low. Many of you would think 1.8%. Gee, that's much lower than mortgage rates. What's wrong with that? But they've increased. It's the change in interest rates when you go from 0.8% to 1.8. It's that increase that changes behavior, that negatively impacts economic activity. And it doesn't happen immediately. It takes time. It takes roughly a year to change behavior. And so we are right now in a period where the economy is already starting to slow. You've certainly seen that with a lot of company news, where their earnings are starting to get hit, and overall economic activity is starting to slow. And now the Fed is starting to raise rates. That's very different when they last had a tightening cycle, which was back in 2016. they were raising rates into an accelerating economy, and that gave them a couple of years of higher interest rates without really disrupting the markets or economic momentum. That's not the case today. The economy is already slowing. Why is it already slowing? Again, because global central banks have been tightening for a year. You also have higher bond yields. You have higher oil prices. All those things lead growth, and they are now in the prospect of slowing economic activity. And now the Fed is stepping in and raising rates. We would argue they're late, and these higher interest rates that they're putting in place risk creating financial strains. And in turn, we don't think the Fed is going to be able to raise rates as much as they currently suggest, say around 200 basis points, because between now and then, there's going to be clear signs that the economy is slowing, and even inflationary pressures are going to come down. So we will get another rate hike, most likely in February and probably even in August. We're not so sure how aggressive the Fed's going to be able to be in the fourth quarter, because we think by then it's going to be pretty clear both growth and inflation are slowing pretty significantly.
So you heard in that clip, again, the opinion of the speaker was that around fourth quarter, inflation would have subsided significantly. It kind of correlates with what we are saying. The other thing I have been talking about is the preconditions of what needs to happen in order for the markets to bottom out and start turning around. So some of them were technical factors, and some of them I mentioned were factors that are supposed to happen in the real world. So in terms of technical factors, it was I wanted S&P 500 to drop below 20%, and I wanted Apple to drop below 20% to get a feel that we are already at the bottom and max pain has been achieved. So those are the technical aspects. When we are talking about the physical aspects, I wanted to make sure that for us to bottom out and start moving upward, we need all the risks to be resolved. The first risk I thought that would get resolved was the China COVID issue and also the China lockdown issue. If that happens, then we'll go to the next level of consolidation and move sideways in the index with a volatility the way it is right now. And then I was thinking that the next one to resolve after that could probably be the supply chain bottlenecks, because we have evidence that some of the companies have had extra inventory. I believe Target had a mismatched inventory, likewise with Walmart. That's what Jim Cramer was talking about, that these executives have paid a lot of money to get it right and they did not. So if Jim Cramer is right, then I think the supply chain bottleneck is easing up pretty well. But I would be dubious about it given the fact that there is China lockdown and most of the things are manufactured in China. So the jury is out on that. But in terms of things that have to get into place, Russia-Ukraine war has to end, and we need to have a supply chain bottleneck easing off. And with the ending of Russia-Ukraine war, the oil price is likely to go down further and stabilize at a normal level as compared to the lower elevated level that we are having at this point of time. So those things will have to be the precursor for any improvement in the market condition. And when these things happen, they will automatically have a very positive impact on the inflation stats, in the sense that the inflation will be much subdued, and as a result of which the Fed can turn benign, and then the market will start raising up. For all these things to happen, I think it's going to take this quarter and next quarter, and probably in the fourth quarter we'll start moving up. So I'm going to show you a press article from CNBC where Jim Cramer is articulating something similar. So here is the article that I was referring about. This article came out on the 20th of May around 6:28 p.m. Cramer's week ahead. Stocks can't stage meaningful comeback until major obstacles are resolved. And among the major obstacles that are to be resolved, he's saying we need China to reopen, Russia to withdraw from Ukraine, and the Federal Reserve to curb stomp inflation with a 100 basis point rate hike. So I don't agree about the 100 basis point rate hike, but we have got a couple of factors that we are talking about that needs to be resolved in order for the markets to get into a much better footing. I'll put a link to this article also in the description below, so that you can have a look at it. As you saw in the previous video, they have more sophisticated graphs, more sophisticated data points, but the conclusion is same, that we are going to have improvement towards the end of the year. So that's one kind of a validation. And thanks to ARK Invest for making their research public. That's why we get access to all this information. I'm going to put a link for that video in the description. It's a beautiful long video with a lot of information. I think you guys should have a look at it, and it's very informative. There is no need for me to reproduce the whole thing here. You can have a look at it yourself. Here's another stat I want to show to you. It's taken from LPL Research FactSet. And you can see this is a table that shows bear markets that last about a year. So it has taken S&P 500 index, bear and near bear markets. That is anything below 20 is bear market, and anything very close to 20 but not yet 20 is a near bear market, like 19.4, which ended in 1978. So those are near bear markets. And if you look at all of them, you find that the maximum drop has been around 49.1%, and that happened in 2002. We are not yet there. And if you look at the average, it is 29.6% drop from peak, and the median is 27.1%. We are in that range. So that also could indicate that we are at a bottom. And if you look at the duration that these bear markets last, the average duration is 11.4 months. And the median is 11.7 months. So from that perspective, maybe we are a bit too optimistic in expecting that the markets will start becoming bullish on the fourth quarter. Maybe not the fourth quarter, but the first quarter of 2023. So that's one way to look at it. But I still feel strongly that fourth quarter is when things are going to pick up. So from that respect also, I think that we are close to the bottom. And we should start seeing things moving sideways from now onwards, a bit of volatility, but consolidation. That's what I'm expecting. The only wild card here, in my opinion, is wheat and the price of oil, both of which are driven by the Russia-Ukraine conflict. We need to solve that in order to get our way through. So that's my bit for today. So that brings me to an end of today's Sunday edition. I hope you liked it. If you did, please don't forget to press a like out there. And if you're not yet a subscriber, please subscribe and join our community for everything related to CRISPR and stocks. And thanks to all the subscribers who have stayed faithfully with the channel for so long. Bye for now. Have a great day.